Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures. Hello, everyone, and welcome to this edition of Macro Minutes called Minority Report. We're recording it at 10:30 a.m. Eastern Time on May the 6th. I'm Jason Daw, your co-host for today's call, and I'm being joined by my colleague Simon Deeley to unpack the federal election and what it means for the timing and scope for fiscal policy, implications for the Bank of Canada, issuance, and the rates market. For some initial context, the Liberals are in power under their third consecutive minority government. There have been 15 prior minority governments in Canada, and this will be the fifth one in the last 20 years. Not surprisingly, minority governments are inherently less stable, and they have averaged just over 1.5 years historically. But the last four minority governments have lasted longer, an average of 2.5 years. Now, the Liberal pre-election fiscal plan, that's been sizable, $130 billion in new measures that will see a larger budget deficit than prior assumptions. And it was focused across the number of areas from direct tariff support, lower taxes in the lowest bracket, housing-related measures, military outlays, and a slew of measures for infrastructure and diversifying trade. So to kick off, the first question is going to be to Simon. I'm wondering, what you think about the political strategy surrounding how this plan gets formulated into a budget. Will the Liberal fiscal plan go ahead in its current form, or will there be negotiations? And from a timing perspective, when should we expect the budget?
Thanks, Jason. There are a couple of judicial recounts still pending, but regardless, the Liberals will finish a few seats shy of a majority win. Although the much weakened NDP, down to just 7 seats, can still put them in majority territory, Prime Minister Carney has said there will be no formal arrangements with any opposition party. The Bloc Québécois has suggested that a period of stability while negotiations with the U.S. occur is their preference going forward. Overall, no opposition party seems keen to push for a quick redo of the election. Looking at policy overlaps, the Liberals should be able to get acquiescence from the main opposition Conservatives on tax cuts, military spending, housing initiatives, and some energy infrastructure projects. It is not necessary that any opposition party votes for Liberal bills, but there would need to be abstentions from opposition members to ensure passage of legislation. So some discussions with opposition parties would be needed to ensure bill passage. Key upcoming dates are May 12th, the swearing in of the cabinet, and May 27th, when King Charles III opens parliaments with the throne speech. If the Liberals are able to get a deal on a broad budget plan, then we could see a budget as soon as June. If not, the Liberals may find it easier to pass more targeted legislation on areas of agreement, or at least non-disagreement, with different parties. If the Liberals go this route, then a budget may not be forthcoming for several months, but elements of the Liberal plan would come into place more piecemeal. Shifting to the macro side, Jason, what are the economic implications from the Liberal plans? And can it offset the negative impact from tariffs and economic uncertainty?
Okay, so if the Liberal fiscal plan is largely adopted in the budget, it could provide a material boost to economic activity. Our estimates are that it could add maybe 0.5 percentage point of GDP this fiscal year and around 1 percentage point to GDP each of the next 2 years. So, there is a chance, obviously, that the fiscal plan gets watered down or the policy mix changes in order to secure a majority in Parliament. But it's probably unlikely that the contribution to growth would be meaningfully diluted. Now, to put the size of the fiscal initiatives into context, it would be enough to offset around a 10% direct tariff hit. And right now, we estimate tariffs are only 3 to 4%, given that most of Canada's exports to the U.S. are USMCA compliant. So a fiscal impulse consistent with the Liberal plan, that would go a long way to offset the second derivative impact from U.S. tariff policy, namely slower global and U.S. growth. Now, the uncertainty factor is the biggest unknown. It is clear that the delta on economic activity is going to be down, but the magnitude is very difficult to handicap at this point. The survey data has been very weak, similar to what we've seen in the US, but how much this translates to weaker business investment and consumer activity is the wild card. But it's probably unlikely that Canada experiences a deep or protracted downturn with the expected size of the upcoming fiscal boost.
Following up, with these deficits set to expand from fall economic statement levels and given some provincial downgrades this year, is Canada's credit rating at risk at all?
Well, the short answer is no. At least recently, S&P did maintain their AAA rating on Canada, despite factoring in growth risks from U.S. tariff policy and fiscal deterioration from larger deficits. Encouragingly, S&P also maintained a stable outlook, which suggests that the bar is probably quite high for a future downgrade. Moody's probably should take a similar stance, in our opinion, based on how they have undertaken rating actions and assessing the range of factors in their rating decisions, especially compared to S&P. The outlier, though, has been Fitch, who downgraded Canada to AA plus in 2020 following the pandemic-era stimulus. And a couple weeks ago, their commentary was fairly downbeat on Canada's fiscal resilience. Now, if Fitch did downgrade Canada another notch, it would probably be a non-event for markets, given their previous rating action and the different approach that they seem to be taking versus S&P and Moody's in their rating decisions. Okay, Simon, issuance was materially higher last fiscal year. Is it going to increase a lot in the current fiscal year? And how does the Liberal fiscal plan potentially impact the issuance size?
That's right, Jason. Issuance was materially higher last year. The minority government could result in a slightly altered mix of fiscal measures rather than automatically leading to larger deficit spending. While we are focusing on new fiscal plans and possible fiscal slippage, the bulk of issuance, 90% plus, is actually from financial needs related to maturities and new requirements that were in the prior baseline assumptions in the fall economic statement. These total $313 billion for the current fiscal year, which started April 1st. Our base case for GOC net and gross bond issuance is about $327 billion, which would be about 35% higher than the previous high for net issuance last fiscal year. A full quarter of this issuance is projected for the 10-year sector, which equates to about 40% in risk-weighted terms. Treasury bill issuance often acts as a shock absorber, and that will be useful given the uncertainties this year. With the BOC starting to buy bills again late 2025, the potential for a larger bill stock is higher than usual. Despite this, we still see risk skewed to more bond issuance rather than less. Jason, switching to the monetary policy side, what is the BOC going to do after holding in April? And how will fiscal policy factor into their future decisions?
When we look at the BOC's decisions in hindsight the last couple of months, it does look like March was an insurance cut when the data maybe justified a hold, and April was a hold when the data more clearly favored a cut compared to the prior meeting. Now, it potentially means that the bar for the Bank of Canada to resume cutting interest rates could be quite high. And we think it probably takes an accumulation, which is multiple months, not just 1 month, of weak growth and contained inflation for them to be comfortable doing more from here. The other point to make is that they were clear that monetary policy is not suited to manage tariffs. And with fiscal stimulus on the horizon, they'll probably be more cautious going forward than they would otherwise. And I do think that they probably want to avoid replicating the pandemic-era mistakes of overstimulating the economy from the dual impact of monetary and fiscal policy, creating future inflation problems. And this is sensible, given they've already cut a lot and core inflation has not yet normalized back to target. So there is a decent chance the easing cycle is over, with the risk slanted to 1 to 2 cuts being more likely, in our opinion, than 4 cuts from here. The market's pricing 2 cuts, and the risk, in our opinion, is that the BOC maybe meets those expectations or under-delivers instead of over-delivering. So Simon, rounding out the discussion, what do you think the implications are for yields or Canada-US spreads or swap spreads?
Thanks, Jason. Canadian yields trade quite closely with US Treasuries of the same term. There are days of discrepancies depending on prevailing themes. Even in the de-dollarization sell-off, GOC yields tended to move directionally with their Treasury counterparts. Our bias going forward is for yields to be relatively neutral near term, but should drift higher as more and more issuance needs to be absorbed by the market. Alongside the risk that the bank may be finished with the easing cycle, and we think GOCs are likely to cheapen against Treasury counterparts in the coming months, with the previously mentioned 10-year sector our preferred tenor where we could see GOC underperformance. Another place where issuance can impact the market is swap spreads, the difference between swap rates and GOC bond yields of the same maturity. We expect Canada's to cheapen in this space over the coming months and quarters. From minus 29 basis points currently, we think minus 40 is a reasonable level.
Thank you for joining this episode of Macro Minutes. There are multiple dynamic factors influencing the Canadian economy, Bank of Canada decisions, and the interest rate market. As these evolve, the landscape could shift quickly, so please reach out to us directly or via your sales representative for ongoing insights.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.